You pay your bills on time. You do not blow money on stupid things. And yet somehow, by the end of every month, there is nothing left. That is not a coincidence, and it is not bad luck either. It is something happening inside your skull, and it has a name. Your brain was not built to manage a 401k. It was built to keep a hunter-gatherer alive long enough to have children. That ancient operating system is still running underneath every financial decision you make today, including the one you made buying coffee this morning. Meet Alex. Alex has a steady paycheck, a decent job, and genuinely good intentions about saving money. Alex has tried budgeting apps, motivational videos, and 3 different savings challenges. None of them stuck for more than a few weeks. The problem was never a lack of discipline. The problem is 3 specific glitches wired into every human brain, including yours and mine. Right now, Americans are carrying over $1.2 trillion in credit card debt, with the average household balance sitting above $11,000. And the average credit card today carries an interest rate above 21%, among the highest borrowing costs ever recorded. This is not a 2008 problem or a 1995 problem. This is happening right now, in 2026, with debt loads and savings gaps sitting at levels researchers are actively tracking this very year. Meanwhile, the average retirement account looks healthy on paper, but the median, the number that represents what a typical person actually has, is a tiny fraction of that. That gap between average and typical is not random. It is the fingerprint of cognitive bias playing out across an entire population. Today, we are breaking down 3 of those biases, with the real research behind them and the real dollar amounts they are quietly costing you. No fluff, no shame, just the wiring, the math, and exactly what to do about it. Stick around, because by the end, you will be able to put a real number next to each one of these glitches in your own financial life. The first glitch is called present bias, sometimes known by its formal name, hyperbolic discounting. Here is the simplest version of it. Offer someone $100 today, or $105 in 3 months, and most people grab the $100 right now. That alone is not irrational. A guaranteed dollar today can be worth more than an uncertain dollar later. The strange part is what happens when you shift both options further into the future. Offer that same person $100 in 13 months, or $105 in 15 months, and suddenly most people are happy to wait the extra 2 months for the bigger number. Nothing about the math changed. Only the distance from today changed. And that distance is what flips the decision. Researchers call this time inconsistency. Your brain treats a sacrifice happening right now completely differently than the exact same sacrifice happening next month. This is why Alex can plan, with total sincerity, to start saving next paycheck, and then somehow never actually start. Next month, the sacrifice becomes today's sacrifice, and today's brain always wins the argument. Alex has lived this exact loop for years. Payday arrives. The plan to transfer money into savings feels easy and certain. Then the actual transfer date arrives, and something else always feels more urgent. A study published through the National Bureau of Economic Research found that present bias is one of the strongest predictors of how much someone actually saves for retirement, even after controlling for income, IQ, and financial literacy. That same research identified a related second bias too, called exponential growth bias, the tendency to underestimate how powerful compounding actually becomes over time. Present bias gets you to delay saving. Exponential growth bias gets you to underestimate what that delay actually costs. In other words, this is not about being smart enough to understand compound interest. It is a wiring issue that smart people have too. Here is where it gets interesting. Researchers Richard Thaler and Shlomo Benartzi tested what happens when you remove the decision entirely. They compared employees who had to actively opt into a retirement plan against employees who were automatically enrolled, with the option to opt out instead. Same employer, same plan, same match. The only difference was which version was the default. Automatic enrollment dramatically increased participation because opting out requires a present bias decision, while staying enrolled requires no decision at all. Thaler and Benartzi also designed a follow-up program called Save More Tomorrow, where employees commit today to having a slice of their next raise automatically diverted into savings. Because the sacrifice is scheduled for a paycheck that does not exist yet, present bias barely puts up a fight. That single insight is now standard practice. Recent data shows the majority of employer retirement plans use automatic enrollment, with default contribution rates around 4% or higher. For 2026, the IRS even raised the 401k contribution limit to $24,500. More room to save. But more room only helps if the saving habit already exists. A 2026 Bankrate survey found only 21% of Americans made real progress growing their savings over the past year, even though most say growing savings is a top priority. And yet, even with all of that nudging built in, the typical American's actual retirement balance still lags far behind what the math says is possible. Across all age groups, the average retirement account balance now sits above $547,000. The median balance, the number that represents an actual typical saver, sits closer to $87,000. Let's talk about that math, because this is where present bias gets expensive. Investing just $200 a month at a 7% average return for 35 years grows into more than $400,000. That is not a typo. $200 a month, the cost of a few takeout orders a week, becomes a six-figure outcome purely through time. Now here is the part present bias hides from you. Delay that same $200 a month by 5 years, and you do not just lose 5 years of contributions. You lose 5 years of compounding stacked on top of every contribution that follows, which can easily erase tens of thousands of dollars from the final number. Wait a full decade instead, and the dollars you never get to compound can quietly erase well over half of what that account could have become. Your future self pays for every month your present self decided saving could start later. To be fair to your brain, discounting the future is not always wrong. Life is uncertain, and a dollar in hand really can be safer than a promise. The real problem is not that you value today. The problem is the inconsistency, planning to act responsibly later, then becoming a completely different decision maker once later arrives. The fix researchers keep landing on is not more willpower. It is removing the decision from the moment your present biased brain is in charge. Automate the transfer the same day your paycheck lands, before that money ever shows up as spendable cash in your checking account. Future you never gets a vote, because future you was never asked. The second glitch shows up the moment money actually gets invested, and it is called loss aversion. Nobel-winning psychologists Daniel Kahneman and Amos Tversky found something strange about how the human brain weighs gains and losses. Losing $100 does not feel like the opposite of gaining $100. It feels roughly twice as painful. That imbalance quietly drives one of the most expensive habits in investing, something researchers call the disposition effect. Picture Alex looking at two stocks. One is up since purchase. One is down since purchase. Alex needs some cash and has to sell something. The winner feels safe to let go of. The gain is already locked in and guaranteed. The loser feels riskier to release, because selling it turns a paper loss into a real one. Nearly every study on this finds the same pattern. People sell the winner and keep the loser. Selling the winner feels good. It locks in a victory. Selling the loser feels like admitting defeat, so it gets postponed, sometimes for years. A major study presented at the American Finance Association meetings in 2026 tracked nearly 190,000 retail investors across more than 40 million trades. The researchers found investors were about 2.67 percentage points more likely to sell a stock sitting at a gain than one sitting at a loss. But the more striking finding was what happened after a string of past losses. Investors who had already taken significant losses became even more likely to cling to their current losing positions, with the bias growing roughly 10% stronger. Investors coming off recent wins showed the opposite pattern, becoming less attached to losers and more willing to cut them loose. Researchers gave this spiral a fitting name, a doom loop, because the very pattern that causes losses is the same pattern those losses go on to strengthen. In other words, the people who can least afford this mistake are the ones the bias hits hardest. Look inside the average underwater portfolio and you will see it. The winners are long gone, already sold and celebrated. What remains is overwhelmingly losers, still being held, still waiting to come back. This is not unique to amateur investors either. The pattern shows up across professional fund managers too, just usually in smaller doses. Interestingly, the disposition effect weakens every December, right around tax season. When investors reframe a losing position as a tax deduction instead of a personal failure, the same brain becomes far more willing to sell. The cost is not abstract. Selling winners early caps your upside before it has time to grow, and resets your tax clock, since gains held under a year are typically taxed at a higher rate than long-term gains. Holding losers ties up money in dead weight, capital that could be redeployed somewhere with real recovery potential instead of sitting frozen in hope. Kahneman's research describes the deeper pattern behind it. People become cautious, almost conservative, when sitting on a gain they want to protect. But the same people become risk-seeking, almost reckless, when trying to avoid locking in a loss. That is backwards. Sound investing usually asks you to let winners run and cut losers early, the exact opposite of what the wired and instinct demands. The same wiring shows up in real estate. Researchers studying home sales found that owners selling during a down market routinely set asking prices anchored to what they originally paid, not to current value, and their homes sit unsold far longer as a result. To be fair to that instinct, it evolved for very good reasons. Losing the day's food supply could mean starving. Missing a bonus meal just meant being a little hungry. The brain learned, correctly, to weigh losses far heavier than equivalent gains, because in the ancestral world, losses were genuinely more dangerous. A stock price dropping on a screen is not the same as losing the harvest. But the brain has not gotten the memo, and it reacts as if it were. The antidote researchers point to again and again is deciding in advance, before the emotional moment hits, not during it. Set a rebalancing schedule or a predetermined rule for when you sell down while you are calm, so panic or hope never gets to make the call in real time. Investors who consistently fall for the disposition effect have been shown to underperform their own portfolio's actual returns by multiple percentage points a year. Compounded over a few decades, that gap is not a rounding error. It is frequently the difference between a comfortable retirement and outliving your savings. None of this requires predicting the market correctly. It just requires removing your own emotions from the one decision that determines almost everything else: when to sell. The third glitch does not wait for you to invest anything. It shows up the second a number enters the conversation, and it is called anchoring. In a famous experiment, Kahneman and Tversky spun a rigged wheel in front of participants that landed on either 10 or 65. Then they asked an unrelated question. What percentage of African countries belong to the United Nations? People who saw the wheel land on 10 guessed a low percentage. People who saw it land on 65 guessed a much higher one. The wheel had absolutely nothing to do with the answer, yet it quietly dragged people's guesses toward whatever number they had just seen. That same glitch is working on you every single time a number appears before you have formed your own opinion of what is reasonable. Start with Alex sitting in an interview, hearing the question every job seeker dreads. What are your salary expectations? Alex answers honestly with a modest, reasonable-sounding figure, never realizing that number just became the ceiling for everything that follows in the conversation. Whoever says a number first sets the anchor for the entire negotiation that follows, even if that number was just a guess. Research from negotiation experts Linda Babcock and Sarah Laschever found that failing to negotiate a starting salary at all can cost a worker between $1 million and $1.5 million in lifetime earnings. That gap lands hardest on people taught not to ask. A study of new graduates found only about 7% of women attempted to negotiate their first job offer, compared to 57% of men. Separate compensation research found that employees who negotiate typically earn between $5,000 and $10,000 more per year than employees who simply accept the first offer. Spread across a 30-year career, that gap alone can mean an extra $150,000 to $300,000, and that is before counting how raises and bonuses usually scale as a percentage of your current salary. A starting gap of just a few $1,000s does not stay a few $1,000s. It compounds every single year, it goes uncorrected. Restaurants use the same trick on a menu. Placing one outrageously expensive dish near the top makes every other entree look like a reasonable choice by comparison, even if those other prices were already inflated to begin with. Anchoring does not stop at the negotiating table or the menu either. Walk into any store, and you will see a price tag with the high number crossed out next to a lower number underneath. That crossed out price is not really about telling you what the item used to cost. It is setting an anchor that makes the second number feel like a steal, even when it is still overpriced. In 2012, JCPenney tried the opposite experiment, removing inflated original prices and switching to simple everyday low pricing across the entire store. Sales collapsed because shoppers had come to rely on that crossed-out anchor to feel like they were getting a deal. The same mechanic hides inside something far more dangerous: the minimum payment line on a credit card statement. Behavioral researchers have found that printing a minimum payment amount on a statement quietly anchors people toward paying close to that number, even when they could comfortably afford to pay far more. At today's average credit card interest rate of around 21%, every $1,000 left unpaid costs roughly $210 a year in interest alone. That interest is money that will never compound for you in any retirement account, because it left your pocket and went straight into someone else's. A balance of a few $1,000s, anchored down to minimum payments for years, can easily cost tens of thousands of dollars in interest before it is gone. To be fair, anchors are not always a trick. Sometimes the first number really is useful, like a fair market price giving you a sensible starting reference point. The real problem is that your brain cannot automatically tell the difference between a meaningful anchor and a random or self-interested one. A wheel landing on 65 should not change your guess about the United Nations, and a store's inflated original price should not change what you are willing to pay. None of these anchors are illegal, and most of the people setting them are not villains either. They are simply using a glitch that works on nearly everyone, including people who already know it exists. The fix here is almost embarrassingly simple. Whenever possible, be the one who sets the anchor instead of reacting to someone else's. Research a real market range before any negotiation. Know what the role actually pays, what the item actually costs, before a number gets thrown at you first. And treat any crossed-out price tag or any printed minimum payment exactly the way you would treat a wheel landing on a random number, as something with no real claim on your decision. 3 traps, 3 very different rooms, a job interview, a checkout counter, a mailbox with a credit card bill in it, and the exact same glitch running underneath all 3. 3 glitches, 3 very different moments, working together against the same goal, keeping money from accumulating in your favor. Present bias keeps money from ever leaving your checking account in the first place, because saving always feels easier to start tomorrow. Loss aversion mismanages the money that does get invested, pushing you to sell winners early and cling to losers for too long. Anchoring quietly decides the price you pay for nearly everything else: your salary, your purchases, even how much of your own debt you pay off each month. None of these are about intelligence, and none of them are character flaws. They are default settings, installed by evolution, running in an environment they were never designed for. A brilliant accountant can still fall for present bias, A disciplined engineer can still fall for loss aversion. A sharp negotiator in every other part of life can still walk into a salary talk and hand away the anchor for free. Your ancestors never had a 401k, a credit card statement, or a salary negotiation. The wiring is ancient. The world it operates in is brand new. That reframing matters because shame has never fixed a savings rate, and it has never beaten the market either. Willpower is also a finite resource that runs out by the end of a long day, exactly when these biases tend to be most active. Systems do not get tired. What actually works, in every piece of research we covered today, is the same underlying move. Remove the decision from the exact moment the bias activates. For present bias, that means automating savings the day your paycheck lands, so the decision happens once, while you are calm and motivated, instead of every single month under pressure. For loss aversion, that means setting your investing rules in advance, written down before the market moves, so panic and hope never get to override a plan made in a clear head. For anchoring, that means researching real numbers before you walk into any negotiation or big purchase, so you are the one setting the frame instead of reacting inside someone else's. Alex did not fix any of this. With more discipline, Alex fixed it by building 3 small structural changes that made the old wiring irrelevant. A paycheck that automatically splits the moment it arrives. A simple written rule for when to sell an investment. A number researched in advance before any offer is made. None of it required becoming a different person. It only required understanding which moments. The brain could not be trusted to decide alone. The goal was never to outthink your own brain in the moment. It was to build a life where the moment never gets a vote. Knowing a bias exists is interesting. Building a system around it is what actually changes the number in your account 5 years from now. Your brain is not broken. It is just running software that was finished a very long time before money, markets, or paychecks ever existed. 3 small structural choices will not make headlines, but stacked over a working lifetime, they are worth more than almost any stock pick, side hustle, or savings challenge you will ever try. That is the real story behind why smart, hardworking people still end up feeling broke, and it has very little to do with how hard they work. If any of these 3 showed up in your own story today, you are not alone. And now, you know exactly what is happening underneath it. None of this requires perfection, just better defaults built once and left alone to work for you. If this helped you see your own money decisions a little differently, hit subscribe so more research-backed breakdowns like this one find you. Drop a comment and tell us which of the 3 hit closest to home: present bias, loss aversion, or anchoring. And if you found this useful, share it with the one person in your life who needs to hear that their brain, not their character, has been the problem all along. This has been the Wealth Metrics. Real numbers, no noise. See you in the next video.